Hi guys, Tim Melvin here, coming to you on Tuesday. I meant to get a video out yesterday, but came down with a bad case of granddaughter-itis as my granddaughter was over. I'm going to be picking her up from daycare here, helping mom out this week while my son-in-law is up in Baltimore doing some stuff. So wanted to jump on here, get a quick video out to you. This week, it's not that much different than when I left you on Friday. The global mess just kind of keeps getting worse, really. Um, the war is continuing to go on. The pointless talks are continuing to go on. Putin is standing by the 4 points, the four things that have to happen before hostilities can end. And Ukraine's not going to submit to those. There's no way. Joe Biden talked to Xi Jinping this week and told him there would be serious consequences if they directly helped Russia. Must have really scared Xi because news on Bloomberg this morning reporting that he is encouraging Chinese companies to step into the void in Russian markets, to take advantage of opportunities that have been created by the West pulling back from exporting key products into Russia. Almost said Soviet Union there. So she doesn't seem too scared. He's going to have Chinese companies kind of rush into the void and provide Russian citizens with some of the things they are not getting from their previous Western suppliers. So China is clearly aligning with Russia, and I think their long-term interests are joined far more than those of the United States and China, in spite of the trade relationship between the two countries. China really does, I think, feel like they've developed enough of a middle class and other trading relationships that they don't have to depend quite as much on the United States and the West as they did, say, 20 years ago when that growth story was really beginning. So we'll see how this all plays out. It doesn't look great. I've got, really afraid that it's going to drag out for a long time. And I'm terrified that at some point something will happen, either an action by a Western nation or Mr. Putin being brave enough or foolish enough to fire on a NATO country, and we see Rule 5 invoked. Nobody wants that at this point in time. It would just be awful. Anyway, stocks don't really care. They're rallying. They're up over 6% this week. I could be a snapback rally in a bad market. I don't know. We're still flirting around with the 200-day moving average. We had cracked down below it. We'll see what happens. Sharp sell-off in bonds as inflation continues to just run amok out there. We've seen a pretty steep sell-off across the curve. We got 10-year now at 2.37%. When I look at what the interest rate markets and high yield credit spreads are saying, you need to be aware that we came really close to tipping into a whole different market condition that would be very bad for large cap stocks just last week, as high yield credit spreads were really nudging up towards the point where they'd be above the 10-year median. That, as we know from the system that we so joyfully have liberated from Dan Rasmussen at Verdad Advisors, that would have been a kind of a game changer for the condition of the stock market. And we would have had to suggest that you really start to aggressively cut back on large cap stock holdings. Came within 50 basis points, didn't trigger. High yield bonds are still below the 10-year median, telling us that it's not a great time to be a huge buyer of stocks and bonds, and stocks in particular. The longer term returns from here, the next 5 to say 10 years, are not going to be great, in my opinion. I don't know how we're going to get there. It could be continued volatility like we've seen with the back and forth as the Ukraine situation has gone on. It could be a giant crash. It could be, as some think, one last melt up before pulling way back. I don't know. I just don't think long-term returns from current valuation levels and current interest rate levels are going to work out well. The real problem that we've got now for stocks, at least in the intermediate term, is Jerome Powell has said he's going to do whatever it takes to get inflation under control. One economist that I read in this morning's paper said that Powell was going to keep raising until something broke, either inflation or the economy, one or the other. I think the truth is it's going to be, if I look again at interest rate markets, they're kind of saying inflation will get under control in 2023 to a degree, but the steps that we take to get there, aggressively raising interest rates and reducing the balance sheet very quickly, could tip the economy into a recession, at least a mild one, later in 2023. We're hiding out in bank stocks for the most part. So don't, we're fine because that scenario works out just fine for us pretty much across the board. Inflation raises the interest rates, which raises the net interest margins, which raises profits. Typically, when we see the economy get into kind of a mild recession, we see an acceleration of merger and acquisition activity. So I think we're good either way. However, rates are going to be going higher, folks, and we've got to be ready to deal with it. We've got to really look at sectors where we can get, especially if you're an income oriented investor, you need to be protected from inflation. I still like higher yielding assets, business development companies that have a significant portion of their portfolio in floating rate assets. GOLA BDC comes to mind. That's GBDC. I like commercial real estate REITs like Ares Commercial Real Estate, ACRE, that has 98% floating rates and is yielding about 8.75%. The GOLA BDC, by the way, it is at about 7.85%. So these are really good, strong yields, but they have floating rate paper behind them, and that's going to help keep the inflation, keep the payout rate moving up if inflation does continue to drive interest rates a lot higher, and we're pretty sure that it's going to. I also like in here the Apollo floating rate fund. It's a 6.6% floating rate yield, trading at about 94% of asset value. That's pure insurance with a 6% plus yield, in my opinion. And the Blackstone mortgage, I really like. Almost entirely floating rate. That's BXMT. 7.8% dividend, almost entirely floating rate loans in the portfolio. And there's only a 64% loan to value here. So the world really has to go to the proverbial place in a handbasket for them to start taking losses on loan workouts. I don't think we didn't get there in the pandemic. I don't think I see anything on the horizon short of World War III coming to the shores of the United States that would cause that kind of drastic sell-off in the quality commercial real estate projects in which Blackstone is a lender. They also tend to be shorter term, more transactional loans, financing part of the project or a bridge loan type of situation. So again, you sit there, collect the dividend, floating rate, so you're going to be in great shape even if interest rates do go up. Now, one thing that I love right now here is the master limited partnerships, the infrastructure, energy infrastructure. We're going to be using oil and gas, and I know it's a theme. I talk about it every week, but it's a big theme of mine right now. We're going to use oil and gas for much longer than anybody's predicting. However, we're not building any more infrastructure to speak of. Just kind of nobody wants it in their backyard. The environmentalists are going to fight it. This White House is against it. So it's going to be just very difficult to make new large infrastructure projects work. That means existing infrastructure is going to see increased volumes because, look, guys, there's really only one way out of this mess with fuel prices, okay? We have got to crank up the energy output because we need to be exporting to Europe to get them away from being totally dependent on Vladimir Putin for natural gas and oil, and get a shipping process for getting lots of oil over there and supply our markets to the point where the pricing can begin to come down. Going to be a lot more activity through the pipelines at the processing centers and at the storage centers, in my opinion. Now, a couple reasons, MLPs, which one do we buy? There's so many, they do so many different things. And frankly, if you've ever owned one outside of an IRA, you know that the taxes on an MLP coming on a K1 with several different states involved can be just a royal pain in the you-know-what. So how do we approach this energy infrastructure market? Let's turn to the closed-end fund markets, guys, because first off, when you buy them in a closed-end fund, there's some sort of tax magic that happens, and all these convolutes, K1s are a thing of the past. You get paid out ordinary dividends. So kind of transforms complicated income into ordinary dividend income, which is a much easier thing to process on the tax returns without any special K1s or other filings. Also, in this particular fund, okay, this is called Tortoise Infrastructure, Energy Infrastructure, it's TYG. You kind of own all of the MLPs. You own all the big ones are in here. MPLX, one of my favorites, Enterprise Product Partners, Plains All American, Energy Transfer, they're all in there. Magellan Midstream. You end up with just one little click of the buy button owning this significant percentage of the U.S. midstream infrastructure market. You own miles, thousands and thousands of miles of pipelines and port terminals and shipping terminals and train cars and just everything that's needed to get energy, liquid energy products from one place to the other, from the field to the refiner to the retailer to the store, wherever it has to go. It's going through this massive infrastructure system, and you're going to own a big percentage of it all across the United States. Here's the fun part of this particular fund. It's really been neglected, as most closed-end funds are. There was apparently a big seller in it last year. There's no natural buyer. It got knocked down a little bit. It's still trading, guys, with a 19% discount to net asset value. Okay, and it's got all these wonderful asset companies and assets in it. It's the single oldest MLP closed-end fund. Their sponsor, Tortoise, was one of the real pioneers and developed this fund back in, I think, 2007 as the very first MLP higher-yielding closed-end fund. They've been around a while. They know what they're doing. They're experienced. It's a good fund, has solid performance, of course, very highly correlated to oil prices, but we think those are going to stay pretty high. So we've got this 19% discount. We've got a yield of about 8.5%, if I recall correctly, on this fund right now. Let me just double check that yield because I think I might be a little off by a digit there. My other machine. Yeah, the yield's about 8.78% right now. So that's comfortable yield. Lots of cash flow coming off of these MLPs to support that yield. So look for a pretty good chance. I think that yield will go up over time. However, last quarter, you look to see who's buying the stock. Saba Capital, who is kind of the new sheriff in the closed-end fund market. We know, we've been involved with them. We own securities issued by them that invest in closed-end, heavily discounted closed-end funds. They are not afraid of an activist campaign to close the discount, whether they want them to turn it into an open-end mutual fund, convert to an ETF, do a buyback, do a tender offer, whatever it takes to narrow the discount to net asset value. Saba Capital bought about 2% of the outstanding shares in the fourth quarter of 2021. They're not up to the 5% level. They haven't said anything yet about what they're going to do. But remember, they're currently involved in an activist fight with another midstream energy MLP, Salient Partners, that we fully expect them to win. We've recommended a position in that before as well. We really think they're going to get aggressive. They're going to lean hard on the board of directors. They'll eventually get to the 5% level, and there will be a 13D filed. That's how I think this plays out. Even if I'm dead wrong and that doesn't happen and they're just a passive shareholders, we own this significant pool of assets that's producing tremendous cash flows, which are being paid out to us as ordinary dividends over time, and longer period of time than having an activist involved. The discount would tend to close itself as buyers kind of noticed that it was an attractive level. But I think Saba is going to force the issue, and we could see some measures taken sometime in 2022 to push that discount dramatically lower, or even open-end it, convert to an ETF, and completely eliminate the discount, which would be a very nice profit for us indeed. Okay, guys, I don't want to run too long on this, but I do want to give you this week's high-yield bargain bank stock, and we're going to go with Ames National. That's ATLO. It's a collection of banks, and they used to subsidiary banks. I think there's 5 of them, but they all come back through the holding company. It's in Ames, Iowa, and in the area around there. It's about 30 miles north of Des Moines, Iowa. It's home of the Iowa State University. There's a bunch of large U.S. Department of Agricultural office buildings and projects in that region. They're one of the largest employers in the region. And what's interesting about this bank to me is that sitting here, only about 53% of the bank's assets are actually lent out right now. Most of the rest is in securities that can be repositioned, or you can use the cash flows and maturing securities to be continually reinvesting as our yields are moving higher, and that's going to increase the cash flow and the earnings of the bank, theoretically increasing the stock price of the bank. It's, there are municipal bonds, treasuries, short-term mortgage-backed securities, that type of thing. So very diversified loan portfolio, guys. They're kind of spread out. They've got commercial real estate. They've got business and industrial. They've got first-family mortgages. They've got some multifamily. And, hey, big shocker, in Iowa, they've got 22% of the portfolio is either farmland or farm loans. And No problem with loan losses or anything across any of the portfolio. Non-performing assets are just 0.60% of total assets. Plenty of capital on hand. The bank's in good shape, very conservatively managed. Um, During the course of the last year, and it's been smaller buys, a few hundred shares at a time, but it's been very persistent and consistent insider buying of the stock. So insiders, people running the bank, the directors and officers, are still quite bullish on the long-term future of the bank. So am I. I think you're at 9 times earnings and a 4.23% dividend yield and buying back a little bit of stock every year. So it's got a decent total shareholder yield. I think it's hard to go wrong with shares of Ames National. Again, symbols ATLO. That's your high yield bank trade for the week. Buy it, tuck it away, forget about it, come back when it gets taken over someday. Anyway, I'm Tim Melvin, guys. Thanks for spending a few minutes with me here on a Tuesday afternoon. I've got to go pick the grandkid up at daycare here shortly. So thanks for watching. I'll talk to you later this week.